So our next speaker is Xin Cao from University of Maryland.
Really appreciate inviting me for presenting the paper. I'm very impressed by the conference program. Actually, I bought a non-refundable air ticket to the conference, but unfortunately, I got COVID a week ago. So I was debating whether I should risk myself, go to the conference, maybe I get better, or just be safe side. I just present online. So eventually, you see, I think it's but for the better of safety of everyone. I think it's a better way for me to communicate the paper with you guys virtually. So having said that, I'm very impressed by the program and looking forward to your comments. So I think Gio did a very great job. Let me do the read mode. Yeah. So I think the appreciate the conference organizers very thoughtfully put the two papers together. I think Gio's paper serves as a very good motivation of the paper I'm presenting right now. So there's an open question here: should man replace machine, or should man and machine can be complementary together? So the paper I'm presenting here, we're trying to, so the Geo give a very good descriptive evidence on how exactly they're complementary or they're substitute each other. So in this paper, what we're trying to do is we're trying to provide some solution, some patterns that how man and the machine can work together. So basically, this is what we're trying to achieve in the paper. So if you guys read the paper, you know this is a long paper. We have like 4 deep learning models employed in the paper, and it's a lot of variables, textual analysis. But I want to use one slide to summarize what we have done in the paper just by 3 things. Basically, there's 3 questions we're trying to answer in the paper. The first one is we're trying to build a machine, the machine analyst. The machine analyst can actually crawl any particular firm's information and make a price forecast. So for example, if I want to know what Google's stock price in the next 12 months, what the machine can do is the machine can crawl the Google's press release, 10K, financial data, stock movement. So every single information about Google, the machine can crawl the Google instantly and comprehend the information and give a forecast. So that's what we did for the first question. So we spent about 3 years actually develop the system, because there's a lot of textual data, there's a lot of patterns. So we run a lot of different deep learning models and parameter tunings, and in order to make the machine to comprehend the complex information of the firm in the past 5 years. So after we done that, what we show is the machine, after the 3 years work, we can beat about half of the Wall Street analysts, speaking of forecasting future price. So basically, the machine, what we are building on, can better understand the firm information and make a more accurate price forecast, more accurate than half of the Wall Street analysts. So that's the first part of the paper. So then we move on to the second part of the paper is we want to identify what kind of incremental skills human have and the machine do not have. So apparently, later on, I will show you the results. The machine can understand the textual information way better than human, and some nonlinear relationship way better than human. But human actually has a lot of skills the machine cannot deliver. So I will talk about more later on. For example, we found that the machine is difficult for machine to understand the management teams, like the intangible skills of the management teams. That's difficult for machine to understand. Also, it's very difficult to machine to understand infrequent event. So for example, pandemics and also financial crisis, these are very infrequent events. The machine need a large training sample to understand the pattern of the events. But for those infrequent events, human being, we sometimes learn from our life experience. So we can understand these infrequent events way better than the machine did. So there's something we document in the paper that human actually has advantage, understand this small training sample, infrequent events, also soft information about R&D management teams, which machine cannot really comprehend well in current stage. So the third part we did is we want to combine man and machine together. So basically, we want a system which has the machine's computational power as well as humans' art of understanding soft information and also logic of getting insight from infrequent events. So this is the last part of the paper. We want to combine them together. And also we try and also provide implication for our students. Like in the current AI world, what should we do? Should students be really completely replaced by machine, or should our students really get prepared to work with machines? So this is something we also we want to provoke us to think what will be the future of the world in terms of the emerging technology. So going forward, so I want to spend some time to explain what kind of input we put in the machine. So earlier I was saying, taking the Google as an example, we put a lot of variables as the input for the machine to understand the price pattern and predict the future stock price. So first we use firm characteristics. So we survey all asset price literature, market anomaly literature. I'm sure we cite a lot of some of the papers from the audience. And so basically, for any variables which have relationship with the future stock performance or the operating performance, we will put that variable in our input as the firm characteristics. We also put industry level variables like competition, product market variables, industry size, and to make sure these variables are also relevant to predict the future stock price. And as you guys know, inflation and oil price, these are also very important variables to understand the firm future operating performance and the stock price. And the later part, which is the heavy data part, is the textual information. So what we include for textual is we include all the press release of the firms. It's about 5 million press release historically, and we put that in as the input for the machine to understand. I also the firm's annual report as well is as also input to understand the firm's pattern. So many of you guys do a lot of textual analysis, and you guys know that just by using single keyword search is not sufficient, because single keyword bag of words approach will not consider syntax and context of the textual information. So each word is isolated without considering the connection between the words. So when we process this press release, we use another paper I developed from my other paper. Basically, we use a deep learning model to incorporate the syntax and the connection between the words to pre-process the press release first. Once we pre-process the press release, use the deep learning model I developed from the other paper, we kind of can get more informative information from the press release and the annual report as the input to the machine analyst model. So we did some pre-processing to get the textual information out. And then to get the as a first as a simple way for dimension reduction on the textual information in order to make the model more get more informative textual information. So I put some citation there if you guys are interested. How exactly we can get the syntax and the connection between the words, you guys can check the paper out. So and then the final model, what we did is we used random forest, gradient boosting, and LSTM, and we assembled the three models together as the final model to understanding the firm information to predict a firm stock price. So some of you may be curious why we choose these three model, why not something else? So normally, normally what we do choose model is we have two ways criteria to choose the machine learning model. The first one is ex ante. We want to use the model ex ante we believe will work the best. So definitely LSTM, it's a must when we understanding the firm's time series data. And then gradient boosting and the random forest, these two, the tree-based model has been showing very good at doing the nonlinear, understanding the nonlinear relationship of the firm information. So ex ante, we do have some expectation that these three models will work well for understanding the firm's textual information and the numerical information. But what we actually did is we actually run all machine learning models just to make sure our ex ante expectation is actually can be validated using the empirical exercise. So basically, we run all the machine learning model to make sure what's the best model actually we can use to understanding the firm complex information compared to human beings. So this is the final model we used, and the reason we want to ensemble them is because each model has their advantage and some so when we ensemble the three model together, random forest, gradient boosting, and LSTM, we're trying to get the advantage of each model and trying to mitigate the limitation of each model. So this is like a teamwork for the three machine learning model together. So so there's some interesting findings I want to show you guys, and also I will introduce some follow-up studies of this paper. So what do we use to proxy the information is we use the firm's news to proxy whether the firms have a lot of textual information or less textual information. We also use the organizational capital and also the R&D to proxy the firm's intangible information and also management team intangible skills. So what we found here is, like I said earlier, when the firms has large textual information, machine in general will do better than human one to understand these numerous information. But when the firms has high capital, organizational capital, and a strong management team or R&D, and in that case, human beings have a better understanding of this kind of soft information compared to the machine. And we also talk about the infrequent event. Machine is less capable of understanding infrequent event, or while human being can get more insights from the infrequent event. Maybe sometimes the human beings logicking and the induction sometimes at this current stage it's better than the machine. So I want to show you guys some interesting graph, some descriptive some pattern, and we can discuss more on this. So this is the pattern what we found earlier, and we found is some kind of puzzling. So you can see that in the earlier year, like 2001, it's actually it's very difficult for man beats machine. So basically, in the earlier years, the man very difficult for man beats machine in the early year. But along the time, in the recent years, it's easier and easier for analysts, Wall Street analysts, to beat the machine analyst we build. So there's you can see that along the time, the man actually perform better versus machine, speaking of predicting future stock price. So what we want to, it looks puzzling at the beginning, so we're trying to dig into the data to see what is going on. So what we did is we trying to get all the brokers recruiting ad. So basically, we trying to find what kind of analyst and also backup team brokerage trying to recruit over the time. So one interesting pattern we found is over the time, a lot of brokerage firms, they're trying to recruit computer science people, and also statisticians and mathematicians as a backup team for the analyst, for them to help them to for analysts to make a forecast, yeah, like you guys know, I was actually computer science before, much earlier, and then I switched to finance and accounting. So it's actually not happened to me. This trend is happening in the industry. A lot of brokerage firms, they actually recruit computer science people, or they recruit analysts with strong computer science background in the recent years. So that's why we see that in the recent years is actually it's not a pure man right now. In the recent years, it's already man plus machine model. So the analysts, they already have computer science team as a backup, or themselves are well trained with computer science skills, as shown in the recruiting news, in the recruiting ad of the brokerage. So and then so what do we? So that's a very interesting pattern I want to show you guys. And also another thing we want to just want to address is, when we say we beat about more than half of the Wall Street analysts, are we always beating those worst analysts, or we can also beat the top analysts? So this is analyst. This is the test. We're trying to split the analysts into the top ones and the bottom ones. We found that we do beat more bottom analysts, but it's not the story, because even for the top analyst, the machine can also beat a lot of top analysts as well. So our results is not concentrated beating the worst analyst. We also beat the good analyst as well, but proportionally we do beat more the analysts who didn't perform well in the past. And then I guess by now some of the audience have the natural question: is really fair comparison? Because the machine, the objective function of the machine is to give a best stock price, but analysts are human. Human has a lot of incentive. Analysts, they give forecast. Sometimes they want to please the managers. They want to get the promotion. They want to make their boss happy. So human being has a lot of incentive besides giving accurate price forecast. So is this fair comparison when we compare machine forecast with human forecast? So what we did here is we're trying to use another model, deep learning model, to model the human incentive. So basically we're trying to disentangle analyst incentive. One is to predict the stock price in an accurate way. Another incentive is their career concerns or networking incentive. So we're trying to disentangle the analyst incentive of forecasting price. We want to debias the human incentive of the analyst, and we do the comparison to see, after we debias the analyst incentive, would the human perform better. So the conclusion here we found is, when we debias analysts, other confounding incentive, they do better in terms of do the stock forecast, but it's not cannot completely explain the findings. So in other words, when we see the machine beats human analyst, the human incentive cannot completely explain why machine outperform human. It does explain a proportion of the outperformance, but do not completely explain why the machine can perform human incentive. So then it goes to the story wheel goes on. So
you have 5 minutes.
Okay, so in the 5 minutes, I'm going to wrap up the story here, and trying to see what is going on with the portfolio. So so what we have here is we want to see the portfolio performance. So basically, let's say if you guys trust the machine we built, and the machine gives the buy and sell signal, and then we contrast that signal with human analysts. So we follow that signal, we form the buy and sell portfolio, and it's about 1% monthly alpha, and after just 6 risk factors. So one interesting thing I share with you guys is I present this paper in some of the hedge funds. Most of the practitioners and industry experts, they're very interested on this table, and they just want to go straight to this table. But most of my academic friends, they are kind of interested on what's the implication for the labor markets, like what humans should be prepared for the emergence of the AI. And so let me, so given the time, let me just quickly summarize the conclusion, and also give you guys some of the following studies we have doing right now. So in summary, what we found is man can understand, the human can understand the soft information better, but the machine can process the voluminous information, nonlinear information better. And then in the current stage, the brokers are recruiting more and more computer science and analysts with strong computer science background, and also human can understanding the infrequent event better than a machine as well. So so what we did is we want to do a combined system. So we want to combine the man and the machine together. And then when we combine them, we found the combined system have the advantage of the machine as well as the soft skill of man as well. So in conclusion, what I want to say is the bottom line here is it's not a world man will be replaced by machine. It's also not a world the man's job will disappear. I think it's a world how we should prepare ourselves to be ready for the machine. So I think for our students, for some curriculum, what the students can prepare for is students can have better understanding of the industry, institutional background of the firms, understanding the management teams, have the skill to understanding the soft information of the team, as well as the students should get some necessary data analytical skills ready. So in order to have a combined man and the machine together, the current talent should be able to understanding the AI as well as be able to have the skills of understanding soft information as well. So so given the time constraint, I will just simply conclude the paper. And also if you guys interested, we have some other paper as well. So in this paper, we built a machine which understanding the firm's information. We have another paper showing if all the firm's information are actually traded by the machine, how should the manager respond to the machine? So basically in that paper, what we show that the manager actually, when they disclose the press release and the news, they're trying to be very picky on the words that's sensitive to the machine algorithm. So there's some words, there's some language are very sensitive to machine and less sensitive to human. So when managers know their press release and the news actually are read by machine instead of human, the managers are actually very, they are strategically use some language that can cater to machine. They join the training camp. They also train their voice and the emotion in order to cater to some voice analytical software as well. So these are some of the some other studies you guys are interested in. You can see how exactly when the AI is rising, how the manager are changing their behavior, how investors are changing their behavior, and we also have some papers using the firms graph, the production graph, to see how does the firms the graph and the productions affects the firm's stock price and affects the hedge fund industry. So I guess I will leave. Again, I really impressed by the conference program, and I'm looking forward to the discussions discussion. Yeah, thanks so much.
Thank you very much, Sin. And the discussant is Svetlana Bryzgalova from London Business School.
Okay, thank you so much for the invitation and for a chance to discuss this really interesting paper. Who is producing the best type of predictions in the asset management or in forecasting stock returns? What is going to happen to the future of the jobs? So these are, of course, the questions that have been at the forefront of the discussions in both industry and academia for at least the last decade. And what this paper does is going a little bit further compared to the standard, prediction exercises, and actually trying to distill why, under which conditions we're going to see the outperformance by various machine learning algorithms relative to the human analyst, or in which conditions we actually do expect to see human analysts beating even relatively sophisticated nonlinear algorithms. So this is really an important contribution. And the paper is really well written. It's very well structured, so I highly recommend everyone reading it because it's a really detailed and extremely thorough investigation of these very important questions. So a lot of the results that Sean already has been kind of talking about. So let me focus on some of the things which I think are important to sort of set down the stage, and then I'm going to look at some of the specific aspects of this comparison, which I think are really important and might be also very interesting to look in the follow-up work. So first of all, we're looking at the 12 months prediction of the price of different companies, which have been forecasted by professional analysts. So the sample starts from 96 to 2018, and compared to this analyst, our machine learning algorithms, or AI, because we also have neural networks, are going to be using a bunch of different information sets. So in particular, there is firm-specific characteristic. So you can think about our usual, ratios that come from accounting. You can think about, different price trends, earning information. You can, there is some industry characteristics. There is macroeconomic data, which roughly is limited to sort of the macro factors have been used in Chen, Ross and Roll and Fun of Range. And there are also text-based information, which includes two measures of sentiment. I'm going to go back to this in a little bit while. So some people would argue that actually the data that is used here for the machine learning, predictor for the algorithm is not as big as in some of the recent studies. So for example, we now have papers that are going to be using not roughly 22 firm-specific characteristics, but let's say 150. We have papers that have been trying to incorporate, 160 macroeconomic predictors, essentially the whole, FredMD database, and not just selected variables that have been identified in the past literature using linear regressions, and as a result, potentially inherit, a certain form of selection bias. But I would argue that the strength of this paper is not to provide, the most encompassing, forecast that machine learning is supposed to be, but instead try to analyze exactly the sources of its performance. And for that purpose, I think it reflects the nature of the underlying data quite well. So what type of methods are we going to be using for comparing the performance and studying their characteristics? This slide is lagging behind the computer because I've already switched to the next one and it still shows the previous.
Okay, let's just try again.
So this is one other example when machine learning is lagging behind humans, but we're learning. So it's.
I love how it's still lagging behind.
Okay, so what people use for forecast analysis? Basically, we use our brains, right? So we don't really have, a good way to quantify. We, of course, use Excel or, other data sheets, but roughly to analyze the data, we're going to be using our brains. What are various machine learning algorithms are going to be using? They're going to be using technical, algorithms, as the name suggests. So you would expect to see some of the standard, suspects in this literature, such as random forest, LSTM, neural networks, or, for example, standard lasso or elastic net type of regressions. Okay, so the key prediction that is going to be used, the key method that is going to be used in the paper is the ensemble of three methods: of random forest, gradient boosting, and of LSTM. Now, I want to be a little bit sort of critical here. The paper refers to these methods as state-of-the-art machine learning techniques. They're not. All of them are more than 20 years old in kind of, their standard off-the-shelf formulation. And so while being in general as a family of the methods extremely, popular and very successful in various applications, they have been incredibly customized for the majority of them. So if we use the standard sort of off-the-shelf procedures, I think it would be fair to refer to them as popular or widespread, but definitely not state-of-the-art, okay? So it seems that we are still struggling. Okay, yes, so that's the brain of my analyst. And these are our methods that we're going to be using. And in the brackets, you see actually the years where, the standard implementation of these algorithms became available. And as you see, they actually have been around for a very long time. Okay. So we can compare the performance of these two procedures, but then on top of that, we can also use the insights from the machine learning methods to essentially try to debias, the prediction of the professional analyst. And we do know that the forecast of the analyst is going to be biased. In part, this is because of, psychological biases, and in part because of incentives that people operate, in the working environment. But I also want to be kind of a little bit cautious with making a statement here, as in, let's use a machine learning technique as an unbiased predictor, and as a result, isolate the bias of humans relative to that. And the reason is because almost all of the machine learning techniques are biased by definition. So they are statistically biased techniques that are developed usually to have the best combination of the bias and variance, which is why they work so well for, decision-making and out-of-sample prediction. But strictly speaking, this is not an example of an unbiased predictor. So when you're looking at the difference between the two, you can say that machine learning works better compared to the human forecast, but both are going to be biased in a different way. And there is a lot of the effort in statistics and machine learning literature actually to try to debias machine learning estimators in the first place. So just to have a simple example, think about OLS and ridge regression, which have been very popular and used in many settings. We know that ridge regression works better in the case of many predictors and or predictors which are correlated, but we know that by definition it is biased. So that's why I think one needs to be fairly careful when we make this sort of analysis. And just as a one example, random forest, where we are building decision trees and we try to average the outcome from the predictions. We actually know a lot about the performance of random forest in general. So we know that under certain very specific conditions and very sampling scheme, it can be asymptotically unbiased, but there is a massive literature in statistics that talks about how to correct the bias that is inherent to the prediction of the random forest procedures as well. And furthermore, there is also a literature that talks about how to build standard errors for the prediction, which is something that currently is absent from all the literature that we see on the application of the machine learning techniques. But actually modern analysis allows us not only to form what's the prediction for the GDP or for the stock price, but also what's the uncertainty that a computer is going to be putting around it. So I think that going forward, this is also one of the aspects of the analysis that we should really be careful about. And this obviously also goes to the majority of the other machine learning algorithms like Lasso, which has been studied for the last 28 years already, and we know a ton about those predictions. And once again, there is a lot that we can do there. So where is the area of the human advantage? So generally, when you think about the type of information that goes inside, I'm going to say that there are two areas of advantage. And one of them is being text data. So text data by its nature is kind of unstructured and is very difficult to formalize. And it is one of the areas where, unlike numerical data or unlike, let's say, graphical data, where humans really still have a significant advantage over even relatively sophisticated, modern, cutting-edge machine learning techniques. Text data provides a lot of the rich information, not just the sentiment scores, which are used in this paper. And this is something that I think going forward, when you're thinking about the role of the human analyst, is something that probably is going to be really interesting to explore further. Because there are many different ways in which we can transform text data into numerical data, and as a result use also as part of the predictors for random forest, neural networks, and everything else. And I think it would be very important to really disentangle what is that information in the text that is really going to be driving either the bias of the human analyst or actually their advantage in terms of understanding different types of risks that the company might be facing or not. And speaking about the sentiment, I'm really happy that Sean was talking about his other paper when he mentioned it, because this is something that I also want to emphasize. when we measure sentiment based on text, it is not enough to just rely on our, standard like McDonald-Lafren, dictionary, and then just to count the words which are roughly positive or negative. There is a lot of the problems that the language brings on the table, especially if you look at the performance over the last 20 years or so, because we need not just general sentiment, but topic-specific one. If you think about, let's say, the importance of ESG, our whole language of how we talk about certain aspects of the firm changed over the last, 10, 12 years. And the sentiment can be quite positive about one aspect of the firm's business, but quite negative about the other. So which is the one that is going to be driving returns? We need to be able to disentangle all of those things. As a result, we need to be able to build dictionaries which are going to be topic-specific. Dictionaries that are not going to be manually constructed, but should be able to adapt, on their own and try to kind of capture, synonyms and the kind of embedding, the phrasing of the language that responds to a particular area. And we obviously need to look at phrases instead of just simple words so that we can deal with negation and everything else. And the sentiment needs to be also context dependent, so it should be a continuous measure, not just something good or bad, but excellent versus, sort of really good or something like this, okay? So, and there are modern machine learning techniques that actually would allow us to distill all of that. So instead of, combining everything in sort of one relatively rough measure, we can try to decompose and see what actually has been going on. I'm just going to show you one very small example of where this difference is particularly large and very visible. So what I'm going to do is I'm going to basically take, those three, steps in building the standard sentiment score related to the economy, and I'm going to use essentially the best algorithm that has been developed for each of those parts, okay? So I'm going to be using word-to-vec, I'm going to be using embedding, I'm going to be using, Hamilton approach to measure continuous sentiment. So at every step of the way, this is, the kind of cutting-edge machine learning techniques. And what you see here is an application to a collection of digitized local newspapers in the US. And I'm trying to measure the level of economic sentiment at the country level. I can also do it at the state, at the city, and everything else for the last 170 years. The language has changed. The style of, people speaking about the economy has changed. And there are a lot of things that sort of make sense because you would see that the sentiment, it goes down during recessions. You can see, for example, the impact of the sentiment here. On the Great Depression, you can see, let's say here, when it was going up during the dot-com bubble, you can see how it burst during the Great Recession. And the last, massive blip, that was the consequence of Trump election. But the other thing that you also see from the sentiment is that it seems like since the start of the 70s, there have been a really strong downward trend. So is it, just the people, our economy in general started doing, worse and worse? Obviously not. We have been experienced a period of really low volatility economic growth. What changed is the language. So if you try to build a sentiment score that's going to be unrelated to the economy, you're going to see that it's exactly going to be capturing this downward trend. The language became much more sensationalist. People click for negative news, for, horror, crisis, the next default and war and other things are going to be just around the horizon. So if you were to just, measure the sentiment, even with the most advanced techniques as it comes directly from the data, you would get a biased estimate because what you capture is a sentiment mixture to a lot of different topics together. In this case, sentiment that was completely unrelated to the economy. Sentiment that you can also see even the coverage of sport news and other things. So, how can we combine a man with a machine? We can try to debias things, but as I mentioned, so I have a bit of a problem with this definition of debiasing the forecast. We can try to add human forecast as an input to a machine learning technique, which has been, a very popular tool. We can try to look at the average between the two, which is, another approach. But there is one that I think I would argue is a really interesting avenue going forward, which is to try to use human inputs to modify conventional machine learning techniques. What is good about human brains? Well, human brains are, of course, good at processing, complex sort of unstructured information, but they're also very good at developing narratives and relatively clear narratives. So if you think about importance of economic theory, we can impose something like an arbitrage constraint on the output of neural network. And essentially, you can think of it as regularizing the prediction for a whole cross-section of firms and not just focusing on, one at a time as an independent object. We can think about smoothing the impact of different variables. We can think about encoding economic narratives and channels through which different mechanisms are going to be affecting not just the price of the company, but let's say cash flows or all the other activities. So human brains are particularly good at developing this. And a lot of these constraints have already been proven to be incredibly useful empirically. So that is, I think, one way in which we can really try to think on how to design machine learning methods with the appropriate economically motivated objective function and with all of these constraints that make sense from the economic point of view. And just to highlight that this is actually a really powerful tool, I'm going to show you another brain that was belonging to a human, but actually manages to overcome and beat machine learning techniques in one particular application. So this is Ian Martin, as you of course recognized. And the reason you see his picture is because the option implied expected rate of return provides a better forecast than the outcome of all of these, machine learning tools that we normally use at the horizon of up to 12 months. So at least in this particular example, we do know that economic theory is actually the one that is beating, unrestricted machine learning forecast. So going forward, I think it's going to be really important to try to think exactly the question that Sean has been asking from the very beginning, which is how do we merge machine learning, all these technical tools that we now have at our capacity, and the input that we humans are good at. And going forward, what should students do? Yes, they should study computer science, they should study finance, but I really think that they should also obviously study economic theory, because there are a lot of really, really useful economic restrictions and modifications that we can develop that's going to make all of these tools, directly suitable for our purposes, for our applications, and are going to be able to really answer, economic questions that we have in mind. So there is definitely a lot of the potential for, the synthesis between the two, and I think we're just yet beginning to understand everything that can be done in this area. Okay, thank you very much.
Thank you, Svetlana. Sean, do you want to take the comments from Svetlana?
Yes. So so thank you so much for the very careful, thoughtful discussion. I think I'm just going to respond to a lot of points I want to address, but I just respond to one comment. I can leave the time for the audience to ask questions. So regarding the textual analysis, I think we should be more careful about writing. We are not just use the sentiment. Actually, we use the traditional backward sentiment, and we also use the deep learning based sentiment as well. So in that case, what we did is we get the sentiment on the future earnings, we get sentiment on the forward-looking statement, we get sentiment on the different topics. So basically, what's suggested, actually we have done in the paper, but we should make the writing more clear. And we actually have the human to read the sentence first, and then we build the model to mimic the human being of understanding this textual information, and then use that. Use the supervised learning to understanding all this information regarding the earnings, forward-looking competition stuff. Yeah, we can be more careful about reading that paper. Right now, we just cite the paper. I was mentioned the model, the deep learning model I did, but we should put more writing in the current paper to explain what we did in my other paper. But I appreciate it, just really great comments, a lot of good stuff I want to address. But I guess I want to leave the time for the audience. Is there any question I can or comments I'd like to?
Yes, we have a question, and maybe you can use the microphone.
Sure.
Let's try how it works now.
So I just have two questions actually, and I must want to go into industry because the first one's about your return graph. So I know your machine learning incorporates kind of all the asset pricing anomalies that we know in the literature. And so I think probably another table or benchmark should be how much the machine actually just beats the asset pricing anomalies, right? So we know there's supposed to be alpha based on the fact you're including things we already know that have positive alpha even after controls, right? So the fact that you find positive alpha after controls is not that surprising. So it might be better to benchmark it against what the alpha would be just based on what we know in asset pricing. So that would be, I think, of interest. The second comment's back on kind of around the recession is when the men or man or whatever we want to call it, they, I guess, I'm not sure what pronoun to use, but anyway, beats the machines, right? And my guess is if you extended to COVID, probably man really beats the machines during COVID. So even
Exactly.
COVID destroyed seasonality trends. So even the Fed's thrown out data from 2 years to not impact seasonality adjustments. So my guess is probably machine learning works well when the trend is intact, and then when there's a major shift in trend, it probably doesn't work as well. And it might be interesting to look at whether or not you see that on individual stock predictions, right? When there's a big detrend moment, is that when man does better than machine? And if so, you might want to think about whether or not that skew is more valuable, right? So there's, and kind of asset management, mutual fund managers underperform during bull markets, but outperform during bear markets. And if you think about utility theory, that's a good thing. So you might want to think about it more on the lines of that, well, if analysts do much better during bear markets or during when trends are changing, is that more valuable than just underperforming a little bit when the trend's the same? So just 2 comments, just really interesting paper. So thank you.
Thanks so much. Thanks so much. Yeah, for the first comments, we can definitely check other benchmark, and also we are extending our sample to the current year. Like you said, we want to see during the pandemics, this is also infrequent event. There's some detrend, structure break. How human doing versus machine? That's something actually we are doing right now. I will, if you're interested, I keep you updated. I will let you know how much machine or human will do better or not better. And yeah, I mean, we'll put that in a new revision. Yeah.
Okay, so I don't see any more questions. So thank you very much. And I think it's going to be only better after the coffee break.